Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at DigiXX.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis. We are looking at a company that is performing a complex, fascinating piece of open heart surgery on its own business model.
That's a strong way to put it.
Well, they're moving aggressively, and I mean aggressively, from a historical foundation in, highly volatile crypto mining toward high-value, stable AI compute infrastructure.
And that pivot, that's the whole story right now.
This pivot, this strategic sea change, is the single core thesis for the bullish case. Absolutely.
Okay, let's unpack that transition. When we look at infrastructure stocks, especially those pivoting to AI, everyone promises compute power. What makes DigiXX's approach different?
Right.
What's the tangible, recent differentiator that secures a competitive moat for them, especially against, the established cloud giants?
The differentiator isn't just power. It's reliability and proprietary deployment. This isn't just a generic switch to rack servers.
Okay.
The company's built a serious competitive advantage through its U.S. data centers subsidiary, which, and this is key, recently achieved Tier 3 certification.
For listeners less familiar with data center vernacular, Tier 3 certification. It sounds like a nice badge, but what does it practically mean when you're selling AI services?
It's a difference between consumer-grade internet and mission-critical operations. I mean, Tier 3 requires 99.98% uptime. Wow. You're talking about less than 2 hours of downtime per year. This validates their infrastructure for high-reliability applications, which is exactly what high-performance computing, or HPC.
And large-scale AI training models.
Exactly. If a massive language model is training for days or weeks, you cannot afford power fluctuations or shutdowns. This certification creates an immediate barrier to entry that, generic miners or lower-tier providers simply cannot overcome without massive, costly upgrades.
So that certification solidifies the quality of their foundation. But how are they actually deploying the capacity to meet this demand? Are they just installing off-the-shelf servers?
No, and this is another part of the moat. They are deploying proprietary integrated solutions. They are rolling out what they call the ARMS 200 AI-ready modular solution.
The modular solution part sounds important.
It's crucial because it allows for the rapid, standardized deployment of these high-efficiency data centers. They currently report a massive combined total power capacity of 196.7 megawatts across their U.S. sites.
196.7 megawatts. Let's put that in perspective for you listening. That's enough dedicated capacity to run roughly 100,000 standard homes. But here, they are focusing that energy entirely on intense, high-load AI training and inference.
Precisely. And this intellectual property, this proprietary ARMS 200 design, coupled with strategic hardware partnerships like their collaboration with Supermicro.
Who are key players in the GPU server market.
Right. It creates high switching costs for future clients. Once a major AI customer validates their model on this Tier 3 certified customized ARMS infrastructure, migrating that workload elsewhere becomes incredibly complex and expensive. That's the definition of moat.
That paints a compelling long-term picture. But investing often requires seeing results in the near term. We know the former crypto mining model meant struggling margins. Have they truly hit an inflection point financially, or is this still just a great story?
The financial story has seen an unprecedented turnaround, and that's not hyperbole. They have made huge strides in shoring up the balance sheet. First, and most importantly for a capital-intensive company, they are currently debt-free.
That's immense flexibility.
It is. Being debt-free in a business that requires building out multi-million-dollar data centers is rare. It shields them from rising interest rates and predatory debt covenants.
Right.
But the liquidity story is even more fascinating. As of late October 2025, their liquidity position was robust. $85 million in cash, deposits, and digital assets.
And that includes some crypto holdings still.
A small but healthy holding of 112 Bitcoin and 1,000 staked Ethereum, yes. But here's the shocker. That $85 million is a massive jump, nearly $56 million from the $29 million they reported just a month prior.
Hold on, let's pause there. Where did that sudden massive influx of cash come from in a single month? That suggests either an asset sale or a major capital raise, which, well, that leads us straight into our risk discussion later.
It primarily stems from tapping into their at-the-market equity program, which we will definitely dissect. But regardless of the source, having that $85 million war chest means management can lock in next-gen GPU orders, secure land, and finalize power agreements before competitors.
So it de-risks the execution of that 196.7 megawatt plan.
Significantly, yes.
Okay, beyond the balance sheet, let's talk operations. We've seen significant revenue growth at 41.7% in 2024, but investors buy profit, not just revenue. Did they actually stop losing money?
They have. They've shown a clear, deliberate path to profitability over the last 3 quarters. This is the proof that the pivot is actually working.
What was the first sign?
They hit a critical milestone in Q2 2025 by delivering positive adjusted EBITDA. Achieving that stability resulted in the removal of the dreaded going concern risk, which usually scares institutional money away.
And then the real headline came in Q3.
Exactly. Q3 2025 actually achieved positive net earnings. This signals a fundamental shift. They are no longer a pure-play miner with razor-thin margins. They are now demonstrating viability as a profitable infrastructure provider.
So the narrative is changing.
Fundamentally, management's effort to control costs and drive revenue through high-margin AI contracts is working.
Okay, that is a compelling bullish story. Liquidity, debt-free, positive net earnings. But our job is to provide you, the listener, with the full picture. So let's bring it back down to earth. 1 quarter of positive earnings doesn't erase a history of losses.
It doesn't.
What is the execution risk and the bear case here?
The execution risk is significant, and we have to look beyond the quarterly headline to the trailing 12 months, which tells a very different story about systemic efficiency.
And what does that story say?
It says, despite the positive Q3, their trailing 12-month profitability figures are still deeply negative.
Give us the stark figures here.
If you look at the last 12 months, ending September 30, 2025, we are looking at a TTM net profit margin of nearly minus 39.25%.
Minus 39%. So for every dollar in revenue over the last year, they lost nearly 40 cents.
Correct. And on top of that, the company is still burning free cash flow, close to negative $9 million recently. This recurring operational loss is the drag.
So the bear thesis is that management is cherry-picking the best quarter to mask deeper, recurring issues that they haven't fully solved yet. They've proven they can make a profit.
But the market needs proof that it can be sustained. That's precisely it. This operational loss is the primary risk. They need to prove that Q3 wasn't an anomaly, but the new norm.
And for any of you who might be considering trading this stock, you really need to understand the technical risk profile. This is not a leisurely investment.
Absolutely not. The volatility here is extreme. This stock has a beta that has been clogged anywhere from 9.72 to 9.92.
A beta of nearly 10. Let's translate that for you. That means if the S&P 500 moves 1% on a generally good market day, you could see the stock potentially move 9% or 10% in either direction.
It is the definition of a high-stakes, high-reward trade. The stock has moved strongly. It's up 166% year-to-date and trades above its key moving averages, which signal strength. But that volatility makes it susceptible to massive, often painful, swings.
Let's circle back to that $85 million war chest. You mentioned it came from their at-the-market or ATM equity program. And that's the conflict, right? Why does a debt-free company with cash need to rely on dilutive equity offerings?
That's the heart of the strategic debate. They are funding this massive 196 megawatt build-out through that ATM program. They've already raised $76.5 million so far. However, they still have a substantial remaining capacity of $123.5 million left on that program.
And that remaining capacity carries a distinct dilution risk. Every time they issue new shares, they reduce the ownership stake of existing shareholders.
It puts downward pressure on the stock price. Yes, it's a trade-off. Management is intentionally avoiding debt by using equity, signaling they prioritize rapid, capital-intensive scale over avoiding dilution.
But the risk is if they tap into that $123.5 million too quickly without corresponding AI contract announcements,
the market could punish them severely for the dilution. It's a commitment to long-term market capture at the expense of short-term shareholder value.
So given this delicate balance between high potential and high risk, what are the immediate events that can move this stock in the next 3 months? What needs to be on our calendar?
The primary flashpoint will be the anticipated Q4 2025 earnings release, currently slated for December 18.
And what are we looking for?
Analysts will ignore the historical numbers and focus laser-like on 2 specific forward-looking metrics: evidence of continued improved gross margins and any forward guidance on cost controls. They're looking for proof that Q3 was not a one-off.
And what about the physical infrastructure? Are the AI plans still just proposals, or are we seeing concrete progress?
We are looking for confirmation of physical milestones. Management has targeted the deployment of the first ARMS 200 pod, that proprietary solution we discussed, by the end of 2025.
A successful deployment would instantly validate the entire strategy.
Instantly. Beyond that, the market is rife with rumors about new AI client partnerships. Any official announcement would be a significant catalyst. And we're looking for updates on the planned NVIDIA B200 GPU cluster deployment, which is expected in Q1 2026.
And what about the long game, attracting institutional capital?
That's why the $85 million cash position is being tracked so closely. Any hint of an uplifting to a major exchange moving off the volatile OTC markets would provide immediate upside momentum. That opens the door to much larger funds.
So there's a date to watch for that.
We should note the next batch of institutional buys filings are due around February 3rd. That date will show whether large investors truly believe in the turnaround story.
So we have a clear, high-growth, high-volatility story here. It's a debt-free company with huge liquidity driving a pivot into AI compute, evidenced by their Tier 3 certification. But they are still shadowed by those long-term negative operating margins and heavy reliance on future execution.
And dilution risk?
And dilution risk. It's a classic infrastructure play, betting heavily on management's ability to execute flawlessly.
The key takeaway for you, our listener, is that this is a long-term vision disguised as a volatile short-term trade. Management strategy reinvesting every dollar from that ATM capacity into building out that 195 megawatt infrastructure target by 2027 suggests they are prioritizing long-term market dominance over immediate shareholder returns.
A lot of patience is required.
Significant patience, yes. But the AI tailwinds and the genuine competitive moat they are building are undeniable.
And if they manage to hit that 195 megawatt capacity goal by 2027, the real question isn't whether the stock goes up, but whether their massive infrastructure scale and Tier 3 validation makes them a prime acquisition target for a major tech firm. That, perhaps, is the ultimate upside.
A provocative thought indeed.
If you found this breakdown useful for your investment research, make sure you subscribe, like, and comment below. We'll be back tomorrow with another Smart Wealth analysis.